Hi guys, this is Craig the Options Linebacker. This is the weekend report for Sunday, May 2nd. Let's start off with this weekend's report by looking at the S&P 500 on the monthly and weekly charts. On the monthly charts, things are finally starting to get interesting again as the month of April ended with a shooting star. Now this shooting star here starts out with a push higher. We can see that it actually pushed higher through the month, but it closed well off the highs. Now a shooting star by itself does not make a reversal pattern all by itself with one candle any more than a hammer does at the bottom of a trend. So what we have to wait for is confirmation that things are actually turning down. But if we look, we can see that this move that we've had off the bottom is very similar to one that we saw in 2003 into 2004. And look at all the hammers that we had in early 2004 as we started to drift sideways finally after this monster move off the bottom. Perhaps that's what we're finally seeing after the price has gotten very close to, but not above that magic 61.8% retracement number. Now remember the importance of this, and this is why I have it tagged as the ultimate target on the weekly chart here, is that generally what happens is as the price is able to close over the 61.8% retracement, what it means is that, again, it will typically fill up the entire triangle of that retracement. Otherwise, it's just one more place for the price to fail, either at the 38.2, 50%, or as high as that 61.8. So what we might be seeing here is that we might see an extended consolidation period, not unlike what we saw in 2004. In fact, this took up the majority of the year before we finally had a year-end rally around Election Day. Now, something else to keep in mind as we look at the weekly chart here is that we're on wave 5. We have a very clear wave structure here. 1, 2, 3, 4, and this is the 5th wave. Typically, this is the exhaustion wave before it breaks into, we don't know what's going to happen up here, but we could see an ABC correction before we see the next 5-wave pattern. But it's clear that the price is at a very pivotal area. Now let's go down to the daily chart of the S&P. As we look at the daily chart of the S&P 500, a lot of these leading indicators that we've been seeing for literally months, which are the MACD histogram divergences, as we've gone higher and higher in price, we end up making lower highs on the momentum here, which is the MACD histogram highs. So again, higher highs in price, lower highs on the histogram shows a divergence there. So we knew eventually that we'd see some kind of reaction to this, but so far really all we've seen is just a move into a sideways coil. Now looking at the daily chart of the S&P with just the price itself, with taking off most of the indicators, we can see a couple of interesting things as far as it comes to fibs. For this move here that we had from January to early February, we hit not only the 127% fib extension, so 100% would be back up to here. Here's a 27% extension. And then finally, we did finally run out of gas right up here around the 161.8% extension. So haven't had a chance to use those all that often until this last move that we've had over the past year. Most of the time we've been using retracements, so let's flip around and do the same thing for this move from the bottom to the top. You can see that we have Fibonacci retracements coming in at some pretty important areas. So the first one of any significance is the 23.6, which comes right around that 1180 support level, which should be very, very important. The next one comes at an even more important one. This is right around 1150, 1152, which is the 38.2% fib. So we should see one of these two levels hold up as support if this trend is going to remain. Now we've talked about a couple of different ways that charts can regain energy. Obviously this one is just out of gas right now and needs to recoil and restore energy before it can keep moving up, if that's in fact what's in the cards. One way it can do it is to continue to coil up like this and wind itself into a series of, it almost looks like railroad tracks on some of the better moves, where it just walks sideways until finally it coils up enough energy that it explodes higher. The other way that it can do that, and this is sometimes a quicker way to do that, is actually in distance. So a chart can restore its energy by walking down in distance as opposed to time, and a lot of times these slingshot maneuvers can have essentially the same effect. Something else that we keep track of every day is the ADX, or the Average Directional Index, and really what we're seeing by this heavy pink line here is the strength of the trend. And what we found is that when charts consolidate or coil up sideways like this, like these railroad tracks that we have here, is that when the ADX gets below about 20, we need to be on guard for the next trend to come along. And in fact, that's exactly what happened here, is that this turned into the next trend to the downside. And as trends get up into the upper 30s, they tend to run out of steam, and that's what this one did. So we went from about 15, 16 on the ADX. Once that trend kicked in, it was to the downside, and it ran up to the upper 30s. And then actually, if you look at this period of time, that was a sideways move. So it gains energy again by consolidation. It dips below 20. Again, 20 is sort of the magic number that we're looking for. On a dip below 20, that says that the market has gone sideways for a long time, or long enough time in this case. And then we started the trend again. And then this trend got up into, yet again, the upper 30s and is now all the way back to 21. So this is what happens, is that we've had this kind of sideways consolidation during this period, and what this has done is gain and store energy in the charts. We're all the way back to 21 again, so we could expect to see a little bit longer of consolidation, or even a dip below this level, below 1180, would further drive this number below 20, and we'd be in a position again for the next trend to kick in. Now actually, we can take advantage of this sideways consolidation. One of the swing trading strategies that we have is actually called the squeeze, and what we're looking for is periods of time where the volatility contracts. And what we're looking for in this case is all these squiggly lines here. We're looking for the pink lines to go inside the orange lines. So if you can see here, the pink lines are represented by the Bollinger Bands. All right. And when they get inside the Keltner channels are represented by the orange lines here. Then we have a valid setup for the signal. We don't have a trading signal for that just yet. But look at this. We actually have the Bollinger Bands are now back inside the Keltner channels. We can see that the last time this happened was early December. We had this period of time here where that signal set up, and all we're looking for is for the price to exit that squeeze, which is what happened right here and right here, as the volatility expanded again, and then a pullback to the 8 EMA. Now I do have an indicator that kind of cleans this up for us in TradeStation, and this is what it looks for. So what we're looking for is periods of time where this particular indicator shows red dots, and that's showing the squeeze. And then as we get into the blue dots again, that's the release from the squeeze, saying that we now have a green light for signal. In this case, it broke to the upside. We can see that squeeze move there. We broke to the upside, and we'll just take a pullback to the 8-period EMA, and that was a nice long signal for us there for that swing trade. Now look at what we have here. We have the squeeze showing up again. So right now, we don't have a green light for a trade, we just have the setup for a trade. We can see that this doesn't happen all that often, but it's a relatively powerful signal when it does show. So that's it for this week, folks. Take care, and we'll see you next weekend.